Apex Trades here. Just wanted to give some information, explain a little bit about what we do, how we do it, and why we, I guess, go against the grain. Go against the grain, meaning, those 95% of traders that generally fail, because the moon boys and moon girls who go with the trade and go with the trend oftentimes get wrecked. It's a known fact. Mainly human psychology is the biggest issue around that, because you see a big red candle and you start to short, or you see a big green candle and you start to go long. The problem with that is when you do that, there's a limited time before the bias changes, and that's because where do you think the move starts? Well, the move normally starts with some form of an idea that the trend wants to reverse. Now, usually it will be institutional, it will be market makers, it will be whales, it will be hedge funds, it will be, big players in the game that will set up the move to start. And you'll see price action rip up or rip down, and it's a setup, because that's where what they've done is they've built the shorts. Let's just say as it's going down here, let's say these shorts have been built. If we mark it off, let's say on this move, let's say shorts have been built, shorts have been built, shorts have been built. Market makers liquidation levels may be up here, and here. Now the retailer starts to dip in here, all the way down, and their liquidation levels are, here, and here. So of course, double bottom played out perfectly. We hit here, couldn't break below the previous pivot low, and of course rips back up to the upside. And all of these retailers here, boom, 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 out for the count. The market makers and the institutional guys who've built all of their trades have all took value and paid themselves as they came out of here. And it's just, it's not complex. It's just something to be mindful of, because it's just how the market works. There is always the fish and there are always the whales, and it's the people with money, like big institutions and people who've got enough clout to affect markets are the ones that are essentially making the money. So, how we trade in Apex Trades is we play with that same kind of idea, and I was building longs, and so the team, all the way down here. We DCA'd. We're currently, I'll just show you this right now. This is our current trade setup for a short. We've been filled on our first one. You can see here, entry number 1, entry number 2, entry number 3, and entry number 4. Position size is really key, because you've got to figure out where your average entry, or where your average order entry is, but you've also got to figure out what your liquidation level is, because that's key. Because even though we ripped down here, we were building longs, knowing that the narrative at some point was going to change. It was some of the FUD around Genesis that was kind of perpetuating this move, but once we ripped back to the upside, we paid ourselves, and it's just the simplest way to trade. You don't have to be a guru. You don't have to time your entries to the perfect spot. Yes, you do need to have some level of confidence around specific areas, and moreover, why are we picking these areas? That's a key thing to understand. Can't always just be willy-nilly, where you just say, well, I'll put my first entry here, I'll put my second entry there, and I'll put my third there. Got to have some sort of education around where your entries are, because what you're looking for is consolidation, areas where there's a good potential we can return. Now, the other thing that we also like to kind of identify, you see this probably better on a smaller time frame, actually, maybe if I go on the 1 hour, is Elliott waves and understanding the pattern, how things play out. And this may not be over, but this could now go into an ABC correction because, the Elliott wave effectively started here. It's our impulsive move to the upside, even though this was a wick. It was during the Asian sessions. Price whipped back down, and then which is our corrective phase. Impulsive wave to the upside, which is normally a 3 wave and usually the biggest wave of them all. Not always, but usually. And then that consolidated consolidation area and more of a kind of a petering out on wave 4, and then wave 5 and just about wicked above wave 3 to technically suggest that this is the wave 5. So what this tells me, when you play these scenarios out with things like Elliott waves and key levels and confluence of things like overbought positions on the MFI, starting to change into the squeeze phase of the squeeze momentum indicator. A lot of these start to come into play, gives you so much more confidence in the way you trade. And ultimately, by DCAing your short positions, so this is a short, this is price action starting to move up. Identified that potentially we're in the 5th wave, and where potentially can it go to? Well, I'd be if this wave went as high as here, no problem. You know what I mean? It's like, okay, well, we factored in the risk element based on our position sizes across each of these sections here, that if we do get filled, and with the confidence of knowing that this is potentially a 5th wave of an Elliott wave, then what normally happens after an Elliott wave is we go into an ABC correction and then a decision on whether it's going to continue to the downside as another Elliott wave, but a short version of an Elliott wave rather than a long, or whether this is just wave 1 of a larger move to the upside. But either, this is where you can start looking at macroeconomics and the bias of where we are as an economic state, and the bias is down. So any move to the upside is going to be relatively short lived. So we're in good shape, currently in profit at the moment. We're on a roll. I think we've hit 14 straight profits. Every trade is pretty much following this basic rule and guidelines. We've been really successful. So if you want to understand some of this and how we trade, and a lot of it is counter trends, so I'm not rushing in with a rush of blood to the head every time I see a big green candle and going, I've got to get in on that. Not interested. I couldn't give two shiny shits on diving into those retail based mentality trades. It's just not going to be me, and I'm not going to be wrecked by the status of missing out or that fear of missing out, because I know there's always a trade around the corner. I don't care if I miss a trade. It's about steady building and compounding to keep on growing your account, so that each time your 10%, 20% allocations, 30, whatever the allocation is and whatever leverage you're using, each time you get a successful trade, that 10% becomes slightly more than your previous trade. So, as your account starts to build, as long as you're sensible and you're mapping out the economics of the trade and putting the math behind it, then generally we're in good shape. So, been a really progressive way in which we've kind of attacked this, and server is open to anyone. Link is in the description. You just come along, say hi, come and meet some of the team. Got some fantastic individuals who are really progressing their own trading path and trading career. Realistically, we cater for everyone, because I know maybe some of these ideas are not, maybe foreign to some, but they're important. They are important to understand and learn, because it's not just a zero-sum game where you learn one bit of knowledge and that's everything. You need to constantly keep understanding, is this an Elliott wave pattern? Why is this a key level? Why do we think, we may revert? I mean, I want to give a shout out to Tino, who's also been a massive influence on me and his trader's reality, understanding things like the market maker moves and how markets trap you into certain into certain narratives. It's such a that was the kind of pivot point for me, actually, the point at which I turned from a TA trader where I was just using things like EMAs and stuff like that, which is still important, don't get me wrong, but understanding how market makers change and trap traders, that was such an enlightenment moment that allowed me to really become a lot more profitable, and a lot confident, and a lot more confident as well. I think that's the key issue here is understanding confidence. And oftentimes, look, let's be honest, when we had this first move in here, right, you're in the red until at least this point, but having that like lack of fear because you're in the red is such a I always say to everyone in a team, the moment you get comfortable being in the red is the moment you start to become a better trader, because we don't use I look, rightly or wrongly, I am not interested in stop losses. I think stop losses are probably one of the biggest reasons why people get reduce their account size, because they are always worried about the stop. If you want to put a stop in, yeah, where'd you put your stop? You put your if you put a trade in where you think is a key level. Let's just say this is your key level, okay? You think we're going to get in here, and I'm gonna put my stop here, right? Okay, so you're really nervous, and it's like, okay, right, here's my entry. Where am I going to go? I'm going to go above, somewhere around here, maybe. I don't know, above this consolidation, but I'm going to put my stop here or something, maybe, because you're on a 50x leverage or whatever, which is just ridiculous. But you're going to get stopped out there. So maybe instead of putting your entry level there, say, okay, well, where would my stop be? If my stop is there, put your fucking entry level there. That would be your new entry, and then your stop can be wherever. So whatever you think your stop's going to be, the way you trade, that needs to be your entry. And I bet you 90% more fills will happen, because, like I say, all of this data here, yeah, there are much deeper much deeper analytical programs like Bookmap, like High Block, all of these kind of platforms that allow you to see where liquidation levels are, where stop losses are, and it's open to everyone. So traders know where your stops are and where your liquidation levels are, and we know we want to hunt for the liquidity. Then that's where it's going to go. So just wise up. Don't be one of the statistics that you know play the retail game. I hate even that name of retail trader. It's like a derogatory term, like, oh, he's just a retail trader, or she's just a retail trader. The reality of it is, retail is just you it kind of feels like it's just it's just something I like to do, but it's money at the end of the day. So if you're happy to lose money, then that's great, but most people aren't. So we need to kind of figure out why and what we need to do to make sure that we're always getting that edge. That's really where most traders become profitable. Understanding just some key ideas, key levels, forgetting about stop loss. Start thinking about DCA as your method of averaging your entry. Because when the return does come, like I say, filled here, our average comes somewhere between here. Get this one filled. This is roughly our average. Get this one filled. Our average is somewhere around here, right? Because where we're at now is okay. Well, now we've shot up so much, but actually it's also become more of an overbought position. Where my current order average is here on my first entry. By getting these fourth positions filled, my average is somewhere here now. So when we do eventually get a downward spiral, let's just say, well, I'm in profit from this point up here somewhere, whatever my average would be. That's the key. Not really thinking, oh crap, I'm going to get stopped out, and that's how I want to trade. I think that comes with conviction and confidence of trading. You know, and I understand why people put stop losses in because they don't want to blow their accounts up. But equally, how many of these accounts are not paying themselves based on just getting the trade right? So many times you see the stop loss get triggered only for moments later for the reverse to happen and come and make your trade profitable. We don't trade like that. I just don't think it's a good way of trading. I really don't. And there'll be people out there that'll say, "Well, you're mad. You're gonna blow your account up sometime." Maybe, but equally, I think we use fundamentals and the averaging method. I'm not going crazy with leverage. That means realistically, our liquidation point might be up here somewhere, maybe even higher, and we're not exposed to 100% of our account allocation. That means we can auto deposit margin to account for any kind of risk level. So that these aren't knee jerk; these are always calculated. And as I say, we've been on an absolute tear. And if you want to know more, link is in the description. But for now, peace, and I shall see you in the next one.